Blood Horse Plus, available through bloodhorse.com, provides exclusive, timely, and unmatched content to subscribers, including Fox Sports, Blood Horse branded weekly programs, a detailed stakes winners section, behind-the-scenes videos from Blood Horse staff, on-demand access to deeper horse statistics, and a $5 monthly credit to equineline.com. Upgrade to Blood Horse Plus today.
At the heart of really what we come to do well is understand our clients.
Understanding what the needs of the family are.
Help them make some decisions.
Preparing the next generation for what's to come.
Being on a first-name basis, getting to know their stories.
Working through their questions, their concerns, and figuring out the solution that's best.
They trust us enough to come in and help them solve that.
You really feel at the end of the day when you add value, there's a great sense of accomplishment and reward.
Henry David Thoreau once said, "It's not what you look at that matters, it's what you see." In managing wealth, there's an awful lot to look at. Taxes and trusts, family meetings and bonds, and everything in between. It's why we rely on those who know each of these fields so deeply that they can see where others are merely looking, who can focus on what's best for clients over generations. After all, that's what expertise is.
When it comes to the horse industry, tax laws are complicated and unique. That's why most people in the horse industry overpay on their taxes. We have the expertise to save you taxes. Why not get a second opinion from the top-rated accounting and tax firm in the thoroughbred industry, the Green Group? There's a reason the most successful owners, breeders, trainers, vets, and horsemen use the Green Group as their tax advisors. We save you taxes. Over the past 40 years, the Green Group founder, Len Green, has owned and bred some of the best racehorses in the history of the sport. His DJ stable competes at the highest level and has received the game's most prestigious honors. Len Green's in-depth, hands-on industry knowledge, combined with current-edge tax-saving strategies, produces positive tax savings results for clients. Take advantage of this special offer. The Green Group will give you a complimentary and confidential review of your tax return. Contact us at 732-634-5100 or visit our website at www.greenco.com.
All right, well, good afternoon, everyone. My name is Gary Falter with the Jockey Club, and I'd just like to welcome everyone to today's online panel. Now, this is the first panel in our series of 10 online Zoom panels this year. And today we're going to talk about how to avoid or prepare for and survive an audit. So very, very timely topic right now. So before we get started, I'd like to recognize our sponsors, starting with the presenting sponsors, the Green Group and Bessemer Trust and Stoll Keenan Ogden. Our panel sponsor today is the company Mersant International, and our Q&A sponsor is West Point Thoroughbreds. And our thanks to all the sponsors for their continued support of thoroughbred ownership and helping us offer these webinars at no charge to you. So thank you very much, sponsors. Okay, so next I'd like to introduce today's speakers, and we're going to start with Leonard Green. Welcome, Len. So Len is the founder of the Green Group, and he's raced many top horses under the name of DJ Stable, including 2-year-old champion filly Wonder Wheel. Also, we have Frank Polino, and Frank has more than 30 years experience in the complex, and I will say it's complex, world of taxation, and has handled over 1,000 IRS state tax audits, IRS and state tax audits at a high success rate. In fact, he told us last week he was going to retire when he loses his first case, and he's not retired yet. So, welcome, Frank.
Thank you.
So we've got a lot of ground to cover. If you have a question from the audience, please use the Q&A button at the bottom of your Zoom screen and submit your question. And if we find that there's questions at about the 20-minute mark, we'll pause and take a few questions and then go back into the discussion. And then at the end of the panel, we'll answer the remaining questions, as many as we can as time permits. So let's get started. So every thoroughbred owner can find themselves at risk of an IRS audit when filing their tax returns. And while an IRS audit can be complicated, it doesn't need to be overly stressful if you follow certain guidelines. That we're going to talk about some of those in today's webinar. So let's get started by let's start off by, how do you avoid being audited? Are there things that we can do as owners to avoid getting that letter in the mail? So let's just start with you. How important is it for owners to run their horse operation in a business-like manner? Can you just talk about that briefly?
Okay, number one, if you don't want to get audited, don't file a return, Gary.
Okay.
That's mine.
Okay.
Then you're really in trouble.
then they'll get you.
And you're really in trouble. Okay. It's interesting, Gary. Over the years, I have seen so many. I mean, we have 800 clients in the horse business. I've seen so many of them who are so successful in the business world, and yet they leave all those techniques and all those methods and all those strategies behind them, and they go into the horse business. Okay, and they say, I'll leave all those decisions to somebody else. Well, that's a good way to get a problem, and it's a good way not to make any money. Okay, so again, the first thing you have to do is sit down and decide what niche in the business you want to be in, and then try to be as good as you can in that business by learning as much as you can, and then running it in a business-like manner. I mean, all these big cases that have come down, Schenker, et cetera, is because they commingled everything. They said, hey, all I'm interested in is having fun. I have a farm, but, all I use it for is pleasure horses. All the things that could go wrong, they're doing.
Okay. Okay. Well, hopefully we can shed some light on that today. So how are taxpayers selected for an audit? Is it like a random draw, or is there certain criteria that the IRS uses to flag someone to be audited? Frank, why don't you jump in on that one?
There's a few reasons it could be audited. They go by DIF score, where they look at your income and your expenses and analyze what other industry does, okay, in that same type of setting. Also, a lot of people forget, if someone that you're doing business with, they get audited, there's a possibility your name may pop up, and that may cause you get audited because they are. Now,
okay.
Lenny said, how do you not get audited? There's no way we could say how you not get audited. All we say is that when we here at the Green Group make sure that when we're doing a return, we could tie into every number. We know that the client has all the backup for it, because we'll explain to the client, this is what you're going to need. So if you are audited, we already started a ball rolling.
Yeah. Plus, Gary, very, very importantly, okay, that the fact that you start this thing in a business-like manner, that you have an LLC, that you have strategy, these are all very, very important things to do. And I mean, later on, we'll get into, should we go to audits or not? And the favorite question that IRS asks the taxpayer when you go to an audit is, okay, are you having fun? Oh yeah, I'd be in this business whether I made money or not.
There you go.
Right. Or
Right.
we actually got one the other day. Guy said, I've been audited 2 years in a row and I'm doing everything. I listened to your podcast. I'm doing everything right. Okay. I said, well, send me your return over. Occupation, hobby. I know why he's being audited.
Right. Okay. All right. So let me ask you this: if a person makes an error on their tax return, maybe some calculation, is that something that flags the IRS to audit them, or is that just they send you a letter and say, here, you made a mistake?
If it's something like where there's a 1099 or W-2 or something like that the IRS has, that's the only way they would see it. But if you made a mistake on an expense item, okay, the IRS don't see that until you're audited. Okay, so that's not going to trigger an audit.
Well, Frank, except that you do look for certain signals. And for instance, if they're racing and they make $100,000 a year in their racing, they should have $10,000 of jockey fees. They should have $20,000 or $30,000 of vet fees or training fees. I mean, there are criteria that you can look at, Gary, if you know what you're looking at, and you know that's going to stand out.
Well, let's talk a little bit about those who help owners with their taxes. So many owners, as you said, they have their own businesses. Often they have an accounting firm like yourself or another accounting firm. Maybe they've got an accounting department do their taxes. So talk about how important it is for an owner's accountant to have knowledge about the horse business. Is it important, or is accounting regardless? Should they have knowledge of the industry to know what to look for?
I'll answer that one. On account, I have an audit that's going on. It's probably a year old. We inherited the audit from another accounting firm. And when I looked at the tax return, he had 4 expenses on the return, but all those expenses were $1 million, 800,000, large. But there's some of those expenses like supplies was $1 million and change. There's probably 15 other expenses in between that they could have spread out. So when I talked to the agent, I asked him, why was it pulled? And that was one of the reasons, because the expenses were so large, thinking that supplies is $1 million and change, but it wasn't just supplies, it was 13, 14 other expenses in that number. Okay, so a lot of accounting firms don't look at, well, the presentation is not good. Let's get all the expenses, whether we have 2 pages of expense or 1 page or 1 line, we need to break it out.
Well, that led to my next question. So there are thresholds for deductions. If you have a high threshold, or you categorize everything, like you said, under general supplies,
right?
They want to see that more broke out, I assume.
Yes,
absolutely correct.
And itemized.
Yeah. Plus, Gary, the biggest one that I have found over the years is the accountant doesn't know whether the horse is running or not. It's on a depreciation schedule. I'll go ahead and depreciate it. Well, maybe that horse isn't running anymore. If it isn't running anymore, you can write off the whole thing. So again, it goes both ways. You got to know the industry. This is a very difficult industry to make money in. Okay, we're one of the few people I think that makes money in the industry. I was on a podcast the other day, and an accountant got up and said, "You're giving them bullshit. Okay, you can't make any money in this business." I said, "Yeah, you really can." I said, "If you win the Breeders' Cup and you win the Eclipse Award and you sell your horse for $3 million, you could make money in this business."
Sure. That's all relative.
Sure.
Okay, so what are some of the other red flags that owners should avoid that increases their chances of being audited? Are there any other red flags that you can point out?
The red flag is, like Lenny said, majority of the horse owners are showing losses. So when you continue to show losses, that could trigger an audit. But we feel here that we've already done our homework with the client, that basically, if you are audited, we're there to defend them, and we've already done the background. In a sense, when I look at it, I put my IRS hat on. I spent 6 years with the IRS, and I say, here's what the IRS agent should be asking. Here's how we're going to protect it, that we have it. Give you a prime example. The other day, I was reviewing a return, and it's the first time I reviewed this return, and I noticed that their insurance were high. The individual owns a farm, lives on the farm, and has his horses there. And when I questioned the insurances, I realized that his homeowner's insurance was included in that number. Now, everything else was clean except that one item. Now, would the IRS say, no, you're intermingling personal expenses with business? The item was minimal. Why even have it there for a minimal expense that could cause a downside of an audit?
Okay.
In other words, don't overbait your hook. Okay, Gary, don't give them more than you have to. Don't try to do that. It's tough enough getting the deductions to start with, and then are you active? Okay, it's really tough. I mean, many people say, well, sure, I'm active. I go to the racetrack. That's not enough.
Okay. Well, we'll talk about some of those things as we progress and get into, okay, now you're in the audit, here's the things you need to cover. But let me ask you about this. So when an owner starts his business, may want to start it as an LLC or a subchapter S or corporation. I mean, are there any flags there that would cause a person to get audited if they set up as one entity versus another kind of entity, or are they all pretty much the same?
I'll answer that one. That one, the answer is yes, because the same situation I told you before about intermingling a lot of expenses, one category, that was on a Schedule C, okay? And when I talked to the accountant about why did he incorporate or an LLC, something like that, it says, all we are is disguising it. What difference does it make? Well, cause an audit, that's the difference it made, okay? You should be either a partnership if you have two people, or an LLC or a subchapter S, okay? But don't go Schedule C, because if you're having losses, the guarantee of an audit is good.
It is greater.
Okay, greater, okay.
Yeah,
So if an owner
and
shows,
Gary,
go
let
ahead.
me add one more part to it. It's not only the exposure to the IRS, it's the fact that we were up at Saratoga last summer and a horse broke loose on the track and came bolting through the horse area. And I said, I sure hope they have a lot of insurance or they're an LLC, because they're going to be some liabilities and some suits against it.
Oh, wow. Yeah, yeah.
Yeah, so you
Okay.
really want that LLC, okay? And there's a certain feeling that the LLC is a business-like manner because you've gone the extra steps to do it.
Okay. So if an owner shows a profit every few years, does that reduce the chances of being audited, or does it matter?
It won't reduce the chance of being audited, because yeah, say 21 you showed a profit, 19 you showed a profit, but your return for 22 is being pulled. They do not know at that point when it's being pulled for audit that the other 2 years you had a profit. It's after the audit already started, they would be addressed that you had that.
Okay, okay.
And Gary, just again, if you ask me one question like, Len, what's the biggest misconception that there is in the taxation of horses? I would say to you, people think you have to make a profit. I mean, we've dealt with clients who have never made a profit per se. 2 out of 7 years is supposed to be the test, but there are 9 tests, okay, to make. So again, as long as you check the box on the other 5 of them, I wouldn't worry necessarily about the loss unless you keep on doing the same thing over and over again. And that to me is idiotic. You keep on doing the same thing and you keep on losing money. I mean, you should be audited, okay, because you're not trying to show a profit. You can't do the same thing every year.
Okay. So I assume every year there's new tax laws that come out, and your firm and other firms, stay up on that. Are there a lot of new tax laws recently that have come out, and things that could affect the horse owner?
Yeah, if I can take this one, Frank. Okay, we're sitting there in January and the House of Representatives passes a law that says effective January 1st, you can take 100% depreciation. We're supposed to be, 60% or 80% last year. Okay. How can they do that? Okay. Well, to make it worse, the Senate is not going to act on it until a couple more months. So you may have to retroactively refile the returns. Okay. Or you can take the position, as we've advised all our clients to do, is take the position that the law is the way the law is. Okay. File your returns with the 80%, then elect something called double declining balance on the remaining 3-year life. So you almost get what you got before. And if you have a carryover from a previous year, you can use it. If you're not in the horse business, those are not things that you do every day. So there's a certain advantage to having the 800 clients, okay? And again, the reason I do it is not necessarily for the 800 clients. It's for DJ Stables and Run for the Roses.
Okay. All right. So let's just jump into, so, you've got the audit letter in the mail, and now it's time to prepare for that. So we actually have a few questions in the queue that I'm going to go ahead and propose those to you guys, because I think it hits on, now that we know we're going to be audited. How do I prepare for that? So here's one. What do I do if I receive an IRS notice? Should I contact them myself, or should I only have an accountant that has experience in the horse industry reply on my behalf?
First of all, you should not respond to you by yourself unless you actually did the tax return. And even if you did do your own tax return, I would notify an accountant. But when you notify account or your accountant that you're using right now, get the experience that he handled audits before and he handled horse audits. Okay. you could have a mom and pop store or 1040 audits. That's different than the horse. Because what is said at the very beginning of your conversation with the IRS could hold against you if you say the wrong thing, because they won't forget.
Yeah.
So definitely get an account or tax person tool.
And again,
So I'll just add to that. What happens if you don't respond at all?
Well, you're gonna probably get another letter. That's gonna be a 30-day letter, another letter saying you didn't respond. They'll assume that you didn't get it. And then after that, they're gonna come knock on your door. Depends on where it is, type of what it is. If it's just a mail order, that's different. But then they'll just take your expenses, disallow it, leave the income. If there's income, just disallow expenses. And now, they're gonna double up, make it a big number to wake you up. Okay, to say, well, now this is what we really owe, and you're gonna say, well, wait, I don't know that much. My tax return don't show it. All in that.
Okay.
They don't play nice, Gary.
Nah.
I understand. So here's a good question. Yeah.
The only exception would be, let's say they ask for proof that you bought a horse. And if you actually have a check, well, then I think you could send a copy of the check in to them that shows you bought the horse. But anything other than that, okay, and again, I'm not knocking big firms and big law firms and et cetera kind of thing, but if you haven't handled a horse audit before, it's different. There, now, you don't know, Gary, because you haven't got much experience in the horse business, but it's really it's a strange animal.
Okay, so let's talk a little bit about how are audits performed. Are they generally done in person, over the mail, Zoom with COVID and everything? Can you have that meeting over the internet, conference call? I mean, how are they typically done?
Okay, course of COVID virus, there's more and more audits done through the mail, meaning that you're sending information to the IRS. But if it's a correspondence audit, all that correspondence audit is if you're missing a W-2, you're missing a 1099, or they can't read the 1099. It's not a fledged audit like on a Schedule C or a corporation for income and expenses. That's completely different. Now, if it's an office audit, that means you have to go to the IRS office at an office audit. If it's a field audit, they will come to you, okay? But COVID changed things around. So we had a bunch of them where we were just able to talk to the agent and send the information that they asked for.
But if you don't know, Gary, what they're asking for, it's not the question. It's what the question is really leading to that you have to know what it is.
Okay. So here's a question from the audience. Material participation, 500 hours versus 100 hours. What is the difference? Not sure I understand the question, but maybe you guys do.
Well, the difference is 400 hours, Gary.
Right.
No, there are certain tests to be active that you have to be 100 hours, and there's certain operations 500. So one of the things that the partnerships stress is join the partnership, because then we can combine certain number of hours that the partnership has, and you can go up and spend time. And I'm not pushing or publicizing West Point, but they do a very interesting thing. It's Saratoga during the summer. They actually take an eating area and they take it over. And therefore, the people in West Point can talk to other people in West Point. They meet other people, and they increase the number of hours that they're involved, because there's then the networking part.
Sure. Okay, that all plays into that. Yeah.
I could add on to that. Basically, when you're under audit, the IRS will look to see how much time you spend with it. And I tell the clients, especially newer clients, that if you're on the phone with your trainer, your jockey, with your vet, to keep track of that, okay, with a diary or calendar, because that's very important to show that that also makes you active in the business also compared to passive.
Okay, well, Frank, that was my follow-up question. So document those times.
That's
yeah.
right.
Plus, Gary, the easiest way to accumulate time is to go to sales. Okay, because theoretically you're going from 7 o'clock in the morning until 7 o'clock at night. Okay. Now the fact that you're walking around and pulling horses, and other people are pulling horses for you, and you're meeting other people in the business who may be helpful to you in your other business, that it all counts.
Yeah. Okay. Well, that's a few questions from the audience. Let's jump back into our dialogue. So, can an owner send his or her accountant to the audit instead of attending themselves, or should they go with their accountant?
I'll answer that one. I think of all the years I've been doing, only once I had the client go, but he was really good. And I went to appeals with the client, okay? Because I felt that he's gonna say the right things. I already talked to him for like days on what to say, what not to say. But I thought he'd be a help. That's the only time, and it did work. It worked in our favor, okay? But I do not recommend the taxpayer to be there, okay? Because even though I'm on power of attorney, the agent's gonna be looking at the taxpayer and asking questions. Even though I'm on power, they should be looking at me, but they're gonna look at the taxpayer and look at their response. I may be talking, but look at their expression on their face. So I feel that taxpayers should never be there.
And Gary, remember, we're dealing with a professional IRS agent versus an amateur, okay, taxpayer who's never been to an audit before in many cases. So if you were the client and I was the auditor and I said, Gary, you look like a pretty intelligent guy, okay, you have a strategy for your regular business, you've made some money, congratulations. Do you have the same strategy for the horse business?
Okay. Yeah. No, I understand that they're very well schooled in what they do.
Yeah.
Okay. Well, so let me ask you this: how much documentation should accompany the owner and the accountant when audited? I mean, do you bring boxes and file folders full of documentation, or how much do you bring?
What I do is if they pick a category and it's a large category, if it's 4 or 5 items, then I give them the 4 or 5 items. But if it's a lot, I would give them a general ledger and say, here's the list. Identify what ones you want to see, okay? And then we get them the invoices, the canceled checks and everything to back that up, okay? But the days of boxes have changed.
And Gary, again, make the agent show his cards as if you were playing poker with him, okay? Let him turn over the cards that he really needs, okay? Because otherwise you may be giving him information that he's not even looking at.
Right.
Okay? That could be something. So there's an awful lot of big dollars involved.
And another reason I do that, Gary, is also because sometimes you wonder, why would this return pull for audit? Was it because they were auditing somebody else? Say they audited the vet and they saw this name pop up. You're going to get an idea by what they asked for in that list. Do they know something more than we knew? That's the reason.
So Len, it almost sounds like that initial meeting is a kind of a discovery meeting, and then there's a follow-up meeting behind it.
Yep.
Very much so, Gary. You're right on. And
okay.
The error that they make is you foul up that first meeting and now you're going uphill instead of a level playing field.
Okay. Okay. So last year we dedicated an entire panel to having a business plan, and to the audience, if you'd like to see that panel's out there on our website where you can watch the whole thing. So let me ask you this: is it helpful to have a business plan going into owning thoroughbreds? And if you are audited, would you bring that business plan or have your accountant bring your plan to the actual audit?
Okay, almost perfect. Okay, have a business plan and then have what changes you have made to the business plan if the original business plan did not work. I want to go into the claiming business. I claim a lot of horses. The horses get hurt. I lose a hell of a lot of money. Okay, do I stay in the claiming business, or do I say, hey, I'm going to claim fillies because at least the fillies have some residual to them? If you talk to an accountant who's never handled the horses before, they don't know the front end from the back end. They don't see the advantages of the fillies versus the colts. Okay, so again, have a business plan, but have an alternative to the business plan if it doesn't work.
Right.
And then have another plan. And if you can't do it on your own because you're dealing with low-priced horses that tend to get hurt, then join a partnership where you get a chance to get a chance to get with a really big horse. And it doesn't take very many big horses to win, to turn it from a loss to a profit.
Now, as it relates to an audit, should that business plan be included in the documentation for the auditor to see that,
Yep.
hey, I'm doing all I can to run this as a business, and here's my plan.
That's why you should have a session on business plans, right? Which you do.
Yeah, well, we did last
I
year.
know, I
Yeah,
know. It's
yeah.
very worthwhile.
Yep.
So, when a person is audited, should they be prepared to cover and discuss the entire tax return, or just the portion related to the horse business, or just a portion that the auditor is looking at? I mean, how much do you have to prepare for? Is it everything and anything, or just a certain area that they're interested in?
Gary, when you get the letter, most likely the letter's going to indicate the items they're going to look at. And if it don't, it just says a blanket audit. Myself, when I call the IRS, I would say to them, what are you specifically looking at, so I could prepare for that? Okay. I'm not going to give them everything on the return, like the real estate tax that has no bearing on anything, medical bill. I'm going to specifically ask the agent what they're looking for. Okay. So that's where the accountant comes into play. A good accountant, good tax guy knows what to ask.
And you
Okay.
give them the least amount of
That's right.
information, Gary.
Okay, all right, good point. So, being audited, it can be a nerve-wracking experience. I've been there. I'm sure many people have. How should an owner present him or herself if they decide to attend on their own behalf? I mean, should they just be very, very casual about it? Wear a suit, wear a nice outfit, look business-like, or just go in and, just be very casual about it? What are your thoughts, if that matters at all?
Well, if the owners are gonna attend and they own a farm, their only business is the horse biz or whatever, cattle, whatever it may be. Why would they go with a suit? Because they're not wearing a suit at work. Okay, and that's 20 years ago. Even the agents don't dress up anymore. Okay, so I would dress where you would dress, not to go to work, but dress, not like a suit. Okay, but I would highly recommend you not to go, because once you're in there, okay, whatever you say there, that's going to be in stone. Then if you don't like the way that it's going, you have to hire somebody. Now we have to come back and try to get out of what you said.
Gary,
Well, that kind of, go ahead, Don.
again, you can't stress that enough, okay? Most owners have something called egos. Not me, but most owners have egos, okay? And they say, you know what, Len? I know what I'm doing in the horse business. I've won 1,000 races, or I've had a treat this winter, or it don't mean anything to the agent. Okay, it's are you showing a loss? Are there certain things on the return that stand out that made you eligible to be picked for audit, kind of thing? And the more you tell them, the more you boast about what you're doing, and you don't care if you ever make any money on this business at all. It's just nice to buy a hat for my wife, and it's nice to be there in the paddock with my friends. You're digging yourself into, and again, I'm telling you the truth. We've handled some of the most prominent horse owners in the business as far as wins or types of wins, and they've been audited and are losing because they felt that they could handle it themselves, or they could hire some large, prestigious firm who didn't know the horse business.
Okay, yep, good point. So this kind of leads into my next question. I think you actually hit on it, Len. It's been said not to give long-winded replies when you're being audited, and to just simply answer the questions without going into a lot of extensive elaboration. So it sounds like you're saying that's so, just be direct, answer the questions, and then just sit there quietly until the next question comes about.
And Gary, it's not so easy. Make believe you're a taxpayer for a moment. And I say, Gary, you're very successful from what you're doing, okay, in the real world, kind of thing. That success just carries over to the horse business, right? Because you use the same principles, and you expect to be profitable in the future, right? Do you just say yes, or do you say no? I'm going to explain to you what I'm doing here. I do things differently than other people. You're digging yourself deeper and deeper and deeper.
Yeah.
Eventually, you're going to say something that's going to hurt you.
By my understanding, they're trained to pick up on anything you say.
That's correct.
Okay. So answer the questions direct and just sit there quietly, I guess. So, okay.
And sit on your ego.
Okay, all right.
Really.
So we've talked a little bit about how to avoid an audit and how to prepare for an audit. And it sounds like that preparation is important. And so let's go into, okay, now you're actually being audited. How do you come out with positive results? So, some would say that the easiest way to survive an audit is to be prepared. And that seems simple enough, but I assume you agree with that statement and talk about what does being prepared mean? And on the other side, what would be not being prepared mean?
Well, I'll answer that one. Being prepared, if they're auditing, first of all, before they go into a hobby or not a hobby, they have to do an audit on your return. So when they're auditing your expenses, being prepared for your expenses, that means you have all the backup for the expenses they were asking for, okay? And there's no personal expenses going through the business. So you have that going for you. Now, after the audit, the agent may say, well, we're going to treat this as a hobby. Now that's a different issue, and that goes back to the 9 points Lenny mentioned before, and we have to address the 9 points, okay? Knowing that, and I've seen enough of them, the IRS is 9 points, they're going to deny them all. Everyone. I've yet to see one where the IRS will allow this one, but the other points are no good. They just deny them all. It's like repetitive. Now you got to come back and count it and see here's where they're wrong, okay? And you don't have to meet all 9 points. You can meet 3, 4, 5 of them, and that could be enough to win, because some of the points are, do you ride a horse personally? Has no bearing on anything, you know?
Well, also, Gary, that again, try to understand what the other, make believe this is a negotiation. And when you negotiate, you usually try to figure out what the other person is looking to get out of the negotiation. The same thing is with this, okay? Is the IRS looking for all the deductions, or will they be happy with a certain amount of deductions disallowed? Okay. Should you argue everything, or again, it hurts you if the checking account has personal deductions and business deductions, if it's not a business account, if it's not an LLC. So again, at least start with the fact that, hey, whatever they look at is going to be business related.
Right. Okay. All right. So you mentioned the nine test rule. Can you go through those 9 tests briefly and give us an idea of what they are?
I be
Sure,
honest, I don't.
sure,
You
sure.
have it in front of you?
Oh, yeah, it's just not that I have it in front of me. I have it embedded in my brain. Okay. Again, what the 9 points are basically is, do you run it in a business-like manner? What does that mean? Let's try the LLC. Let's try the subchapter S, because it's a strict business account and there's nothing else in it. Number 2, do you have a business plan? Now, you don't have to follow it all the way, Gary, as you know, because those business plans can be voluminous. But you look at the business plan, and does it make logical sense that it could turn out to be profitable if you are you increasing your chances for profitability by having another alternative? Do you buy fillies and colts, because the fillies can be bred later on? Okay? Yeah, step by step, you see what you're doing? Okay, do you go to sales yourself? Okay, do you talk to agents? Do you talk to consigners? Okay, do you talk to your trainer? Do you get your hours in? I mean, it's really.
Do you have, one of the things is, do you have advisors that understand the business, meaning accountants, trainers, people like that, okay? That's one of the things that they look at. And the funny thing is, you can have a list of the top people around advising you, and the IRS says, we still disallow that one. So that's why I said they're a set pattern. Those 9 points are gone, okay, with the IRS. Now we got to come back. Only that you have to go to appeals. Appeals looks at it differently than an IRS agent would.
Gary, I really believe that this show, otherwise we wouldn't be on it, okay? It really is helpful to clients in the horse business, because it shows that you want to learn more. It's very important. I mean, the whole series has things in it that you really, I'm not saying you have to be experts in it, but you have to have knowledge. You're not picking out 10 crazy subjects that nobody cares about. And these are all very, very good, important subjects. And, you know, when you used to have the panels, when we used to have people there, was even more important because you got to meet people at your table and et cetera. So again, this counts as part of the 100 and 500.
Sure. Yeah. And just attending this webinar and any of the other webinars. And again, we have the past 2 years of webinars on the website. So at your leisure, audience, if you want to look at any of those topics, they're out there for you to look at.
So Gary, you certainly can, between the webinars that are on the 100 hours, you can check the box. I mean, that's easy.
Right.
And
So
Gary,
good, Frank.
Basically, if the taxpayer's going to go to represent himself, the IRS will ask you the same questions 4 different ways. Okay, so they're trying to trick you into answering 4 different ways the same question.
Good point. Yeah.
And it's not like regular law. With the IRS, you're guilty to proven innocent. So your expenses are 0. You have to prove they're correct. So
I've heard that. That's it's sad to think, but it is so. Yes.
And Frank, how many new agents did they hire? Thousands.
Yeah, thousands.
Yeah.
And are they focused on just returns, audits?
Be audits, but the funny thing is, I always say that I rather have an experienced agent than a rookie, because the rookie are asking questions, don't know why they're asking that questions, but that's the questions you don't want to answer.
Yeah.
You know, so I'd rather have someone more experienced, but more experience will lead right to the point. Let's get it over with. But a rookie then has to go back to his group manager and supervisors, and there's too many other people getting involved with the audit, which you don't want to happen.
Okay. Well, I've got a few more questions. I'm only going to ask one because we have a load of questions in the queue from the audience that I want to get to. So I'm going to finish my questions with, so if the auditor assesses more taxes and penalties on a taxpayer, what are the options? Can you appeal it? Do you just pay the taxes and the fines? Do you negotiate a settlement? I mean, what are the options after the final findings are submitted?
So if you're saying that the findings are correct and there is a tax, and there's no ifs, ands, or buts, it is
right,
tax, most likely you're going to have a penalty, but you could always negotiate the penalty, but maybe not with the agent. You may have to go to appeals, but with appeals, you have a good shot. You have to come up with a reason why there were mistakes, and there's usually a lot of reasons you come up with.
Okay, so that's going to wrap up my question. So now we're going to move into the Q&A session because we have a number of questions in the queue. But while we sort through those questions, let's hear an ad from our Q&A sponsor, West Point Thoroughbreds, and then we'll be right back.
How do you become the gold standard in racing partnerships? One horse, one partner, one victory at a time. Congratulations to all our partners who have made West Point the gold standard for the last 3 decades.
Okay, thank you, West Point. All right, so let's jump into the audience questions. So here's one. How detailed should we be in splitting out the expenses? I probably have 15 categories like training, board, vet, hauling, etc. How detailed should I be in splitting these out on my return?
I would definitely split them out. It was like the example I gave you earlier where everybody combined it, and that could trigger an audit because of a large number. Whether it's a page long or not, split it out, because then you have more detail and it's easier to back up.
And Gary, it shows that if you have vet and supplies and insurance. Okay,
You're identifying.
it really shows that you're in the business.
Okay, yeah, that you're operating like a business, sure, rather than just throwing them into one general category.
Amen. Amen.
Okay, so if you are a subchapter
Yes.
S, how easy is it to change to an LLC?
Checkbox.
Yeah, it's all good.
Check the
That's
box.
fairly easy, just a checkbox. Okay,
As long as there's another partner.
I'm assuming that you have a partner in both of them.
Subchapter S, yeah.
okay, so someone commented, avoid the Schedule C, but aren't a single member LLC income expenses reported on the
Yeah.
Schedule C anyway?
Yes, they are. And if you haven't got a wife, okay, or a friend, okay,
Or a child.
or a child, okay, then name your jockey or your trainer.
Okay.
You need two people.
You need two people. Okay. All right.
But it can be 99-1. And there's no liability to the other person. So why wouldn't they?
Okay. So there has to be two people.
It's a great question, though. It's a great question.
Okay. So here's a question. The 100% depreciation you mentioned, is that different than the 179 deduction?
Yeah, again, which you have the advantage. You used to have the advantage of, you had two ways of depreciating the horse or the barn or the fence. Okay. It's funny, Gary. People say to me, what's the first thing you look at when you have a new client? I say, I look at the land account, because the land account's not depreciable at all. But the roadways, the fences, okay, the trees, okay, they're all deductible. So it really, if you know the business, you know what you're looking for. So again, what you want to do is you want to see what deductions you're entitled to, and then take them all.
Okay. So is there a particular size of operation that is more likely to be audited, or does it really matter?
Doesn't matter. It doesn't matter.
Doesn't? Okay.
I've seen from the high to the low, and the big ones not get audited, and small ones with a small loss get audited. It doesn't matter. It depends on where you are, what state you're in, too.
Also, Gary, have you put something down that triggers the computer to say, look at this return?
Okay.
If you suddenly had jockey fees of $100,000 and your horses only made $200,000, you know something's wrong, right? Boom, you put it down. It's kicked out of the computer. If it's kicked out of the computer, you might as well look at a few other things, right?
Mm-hmm. Okay, here's a good question.
That's where if the accountant knows the horse business, they're going to know what looks right and doesn't look right.
Sure.
See, we call it the smell test. Gary, you know it better than I do, kind of thing. And if it smells bad to me, it's going to smell bad to the IRS.
Yeah, yeah. Well, that's a good point, and that'll keep them from hopefully getting audited. So here's a question about the business plan. How detailed should a plan be, and do you have any samples business plans? How detailed should it be?
You know, it's funny. When I'm in class, I teach at Babson College, and people say to me, should you have a business plan? And I say, well, at least, okay, put it on toilet paper, because once you start the business, you're going to have to change your plan anyway. So at least if it's on toilet paper, it has some use to it. Business plan is great to get started with, Gary, okay? And if you start with, hey, I want to claim horses, and you get, let's say you get to be successful and you suddenly change to a Chad Brown or a Todd Pletcher, they're going to say to you, wait a second, we don't claim horses. We get allowance and stake horses. Or Baffert, you know, we get graded stake winners. Otherwise, they get, so you really have to know who you're dealing with all along the line. It has to make sense along the line. So it has to be flexible.
Okay.
But start with something. Start with
something. Yeah, and again, we had a full panel last year dedicated to business plans, and there's a lot of detail in that on what can and could go into your business plan. So to have a look at that too.
Yeah, look at it. And again, you said it a couple of times to look at it, but that was one of the more important panels because it really gave them some things that they should be considering.
Yes, for sure. Okay, so here's a good loaded question for you, Len. How do you find an accounting firm that knows the horse business?
Well, our number.
Call 732-634-5100. And I got to tell you, Gary, it's free. We'll review your return, okay, on a complimentary, okay, and confidential manner, okay, and we'll tell you what to look for. And if you want to change accountant, fine. But if you don't, at least you'll know that there are certain things on there that may cause audits, and there's certain things on there that maybe you will be thinking about that you're spending too much money on. Okay, for instance,
Sure.
insurance. How many people insure the horse 100%? Well, that's ridiculous in the horse business. So you got to draw a line and say, okay, I'm going to do 60% of the value, or I'm only going to have insurance on horses of over a certain amount, because otherwise the insurance can eat you up. Okay, or vet bills. Okay, I'm not going to send any horse to Haggard Davidson or Root and Riddle. Okay, because they're experts, but they're very expensive. So maybe, okay, for a lesser horse, a lesser costing veterinarian would be important.
Okay. So here's a question. I own horses in 3 LLCs with different partners that I run. And I do this outside of my day job, but spend more than 500 hours on the horse partnerships. What's more likely to be audited, my personal tax return or the tax return of one of my LLCs?
The odds are probably going to be your personal tax return, which then could lead into all 3 of those LLCs. Okay, because they have, once your personal tax return is audited, if it's an office audit, the odds are slim that they'll go into the LLC. But if it's a field audit, the odds are great that they may go into the LLC. They'll ask to look at the LLC, and then they'll decide whether they want it audited or not. And they have the right to look at it.
Okay.
And of course, Frank will say to him, okay, I'll give you these, but you and I know that there's nothing in here that's out of the normal, because the statistics are they should have a certain percentage of this. There's okay, they're diversified, blah blah blah. You lead the horse to water.
Okay, here's 2 questions from Canadian folks in our audience. Do you provide tax advice to Canadian horse owners, and also does the Green Group consult in Canada or work with any equine focused partners? So talk about your knowledge of Canadian tax laws, or who would.
Since we're the leading owner at Woodbine every year and we have horses up there, I had to learn the Canadian tax law, which is awful because they have a generalization that says you can't take losses against your ordinary income. But a lot of the Canadian owners also race in the United States. So we suggest to them that they set up a subsidiary of their main business in the United States, which is probably profitable. So then we offset the U.S. tax losses against the U.S. income from subsidiaries. Okay, it's a great question. There's more than one way. You can't just say, okay, it's not deductible.
Okay. Here's one. The rule of thumb is if you do not show a profit at least once or twice every 7 years, the IRS wants to call your horse breeding racing operation a hobby and disallow your losses. Yet it is so hard to show a profit. Does years of continuing losses risk the loss of future ability to continue in the horse business?
I'll answer that one, then Lenny can follow up with it. I haven't had an audit. I have a ton of horse audits where the audit was because they had a profit. All the audits had because they had losses, various between 15, 20, 25 years, 30 years of losses. Once we get involved with it, if we come in after the fact, we look at the whole picture and what caused the audit and what the deductions were. And at that point, I haven't really lost any. I haven't lost any. because we think out of the box. We come up with things. I'll go to appeals, say, with a booklet this big, okay? Showing everything this client did, everything they've done, how much money they made, all the races they won, all that. The IRS will come in with something an inch thick, and it's the 9 points, and all it is no, 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 no. So I look at it, just because you're showing losses, that doesn't mean it's not deductible and you're not going to get it.
Okay, let me add a couple of other items, Gary, that 99% of the people on the listening don't know. If I do that, will they think I'm smart? Gary?
I'm sorry.
I said, will they think I'm smart if I come up with something that 99% of them didn't know?
Sure.
Okay.
Yeah.
Number one, okay, let's say you invest in Stallion shares and the Stallion shares go up in value. You can take that differentiation between what you paid for the share and what the share is now worth and use that against the test of profitability. Number two, I have a farm, and on the farm, I use it for the horse operations or the breeding operations. And the farm has appreciated in value. You can actually use the appreciation in the farm against the loss from operations and turn it into, if it turns it into a profit, you're home run, but at least it shows that there's more than one way. And from a business point of view, Mr. Agent or Mrs. Agent, look at this. Okay, there's not one way to make money in this horse business. There's a number of ways to make money in this horse business, and I'm trying each and every one of them.
Okay. So let me ask you this. You had mentioned a case called the Skolnick case. Is that something you can explain to our audience what that was and how that shaped up?
The IRS calls it the greatest case that they ever won. I call it the greatest case that they ever lost. Because yes, they won in calling everything a hobby. But if you then look to see the basis of how they came to their conclusion, and you don't go down that path, well, then you probably would win the Skolnick case. So what did Skolnick do wrong? Well, they commingled their checking account.
At a wedding. They had a wedding.
They had a wedding on their farm, okay? They had no horses on their farm that they used in business. You see the picture?
Yeah.
They didn't use the farm at all for business. They had no business plan. Question, Mr. Skolnick, do you have a business plan? Why do I need a business plan?
Right.
Ding dong. Thank you. You just nailed the coffin.
Okay.
That's basically okay.
Yeah, that's a good example. So
and
all right.
The final thing was they asked him, would you be in this business? Okay, even if you never make a profit. Of course, it's fun.
Good times.
Yeah. Yeah.
So here's a question from the audience. I own a farm and several brood mares. I lose money most years, but I feel I'm adding value through selective breeding and making farm improvements. Does adding value help when audited? And should I get appraisals on the horses in the farm?
Yes. Yeah, 100%. And that's what Lenny had mentioned before. Okay, the value that's around the farm. Yeah, that's all a factor. Yes, get appraisals on the horses. That all helps. Okay. Without a doubt.
And again, a lot of people now, Gary, are putting their horses on these digital sales and they're getting bids on them. Okay,
right.
If the bids aren't good enough to sell it, it's okay, because now you can see what the value of the horse might be.
Okay, sure. So here's another question from the audience. My stable is an LLC that was put together after an IRS audit many years ago. Does the green group only handle the stable horse side of one's personal tax return, or do you handle the entire tax return, soup to nuts, including the stable horse business?
Boss, The answer is yes.
Yes. Okay.
And
Soup to
again,
nuts.
and
Yeah.
Gary, it's very important. And I know it sounds self-serving for me to say that we should do soup to nuts, but the amount of time that we see revenue examinations that on the surface it looks like they should not have been audited, but they are being audited because somebody who didn't know the horse business picks out some kind of item. Okay, can you imagine promotion? Okay, on a racing operation. Come on, there's no find out what it is, or hats for the Derby. I mean, why don't you just hand it? Why don't you just say, IRS, please come and audit me?
Okay. All right. So here's kind of a lengthy question. I'll go ahead and read it all. How would a person be positioned in this scenario? They were at times a silent partner for 2 years at the 15 to 20,000 level per year and never sought a deduction, but still knew their actual cost. As they became more interested in the industry, they get an owner's license, they form a two-person LLC, and are listed as the managing member in that LLC. They increase their spending in the sport. They have detailed records of all expenses and revenue proceeds. They produce a K1 for their racing LLC and carry the K1 into their overall tax filings with other businesses the person owns. Is this a sound procedure?
Yes, that is.
It really
That
is.
it, totally.
Okay, now whether you want to go back or not and capitalize those expenses that you didn't take before, and if there are horses that you still own, okay, maybe that undeducted expenses for those, let's say they were broodmares, okay, and you didn't take a deduction for them, you can add that to the basis of the broodmare. But yes, you're doing it right now. You've seen Jesus, okay?
All right, good. So to kind of wrap things up, let's summarize what we've talked about. So, avoiding an audit, it almost sounds like it's near impossible to avoid one. But if you do make certain mistakes on your tax returns, or you or you have deductions that are above certain thresholds, you could actually trigger an audit. Is that correct?
That is totally correct.
Okay.
You can't control a return being audited, okay? But you control the results of an audit.
Okay.
So if you cut it off at the first level, if somebody looking at the return actually knows what they're doing looking at it, and actually knows the difference between a colt and a filly and a gelding, okay? So if they have that knowledge, they can look at something and say, wait a second, there's just no way. If you have colts, you can't have breeding expenses. Okay, so again, that's an important first step, Gary. And then again, I'm not interested in, Frank's not interested in just having clients. We want the clients to make money and stay in the business. Okay. The way to do that is run it as a business, not because it'll avoid IRS audits, but because that's the right way to do it. And keep on listening to these Jockey Club sessions. Okay. You're going to pick something up on every one of the sessions.
Well, and it sounds like the next portion in preparing for an audit is run your horse business like a business.
That's correct.
And if you do that, you will be prepared for an audit. And then lastly,
Gary, you were listening.
Okay. Yeah. Okay. And then just surviving the audit, what's the last piece of this, and how do you survive one and not have additional taxes levied against you?
I think you have to know when to hold them and when to fold them on examinations. Okay, the professionals don't come cheap. Okay, so there's a certain point that Frank will come to me and say, here's what the IRS was looking for originally. We've defeated all that, but they say, hey, there's a mixture of this with that, and possibly some personal involved. And I'll say to him, you know what? It pays to do that as long as we don't trigger this thing that to look at it for every single year thereafter.
Okay, Lenny's right. Sometimes you have to bite the bullet. You'll give up something, okay? But a lot of times I'll arrange it with the agent. If I'm going to give something up because they want something, you got to say to me, you're not going to trigger and pull the next year for audit. If it comes randomly, nobody can control that.
Right.
And I have one case where the agent told me on a big case that we did audit 2019. We're not going to look at any other year, but I can't control if it comes through the system automatically, but I won't pull it. That's
Okay.
one.
And that random selection does happen.
Yeah, you can't control that.
It
Can't
does,
control
but
that.
the amount that they're looking at on a random basis is this much compared to a regular audit, Gary.
Okay. All right. Good point. All right. So that wraps up the Q&A.
Great
So for
session.
Thank you.
yeah, it was very informative and great stuff. So in the audience, if you have any follow-up questions for Len or Frank, contact their office. So you see on the screen, they've got their phone number, they've got their email address. So you may think of some questions later today or tomorrow. Feel free to reach out to them, and there's no charge for that initial phone call or email. Is that correct, gentlemen?
Absolutely correct.
Yeah. So
You're paying for all of it, Gary.
if you don't have time to write those down, we'll have this recorded session out there in a day or so, and you can always pick it up from that. So like to thank our panelists for your time, great insights on just an important, timely topic. Thanks to you, Len, Frank, for your time and being with us here today. Really do appreciate it.
Okay, again, Gary, great job.
Yeah, thank you. Thank you. So also like to thank our audience for being here and all the owners in the industry for investing in our sport, because without owners, we simply don't have an industry. So we'll be back in April with another online webinar on the topic of information resources for owners. So until then, we wish you well and hope you visit the Winner's Circle often. Thanks, everyone. We'll see you next month.
Thank you.
Thank you.